Um, One thing we had one request from that reply guy. Shout out to that reply guy on Twitter. Asked to do an analysis on Solana. And let me just share my screen. I wanted to address this quickly. This is a question people commonly ask about individual crypto coins. So this is not part of the core lesson. I didn't plan to go over this, but I just want to make a point here. So that reply guy, Solana, there is really no point of doing any individual technical analysis on Solana. It's the reason why is that it's mainly going to be there's really nothing technical you can glean from it. It'll mainly follow Bitcoin and Ether, uh, and and Bitcoin and ETH are swayed by overall risk taking sentiment in general. So um, if anything were to happen to Solana, if any reason why there should be an asymmetric rally in Solana, by asymmetric I mean rest of the market does nothing and Solana just rips. It's going to be a fundamental reason. Uh, what that could be, I don't know. I'm not in tune with this, but pick your battles. It is futile to do analysis on an individual coin. And this chart, you can't really glean much from it. So you're much better suited looking at the crypto market in general. And to take it a step further, you're much better suited to just look at risk in general and rates, and sort of position yourself around that. And which is exactly what we're gonna do. So that reply got good question. Keep the questions coming. If you have anything you'd like me to address on the sort of show, um, happy to do that. So let's kick it off into the main lesson here. And so the first thing I sort of want to talk about is actually I'm going to give sort of just an overview, the very high level overview. Right now, the stock market and the bond market are pricing two different things. Okay, so the stock market is pricing in inflation moderation and a soft landing. And the bond market is pricing in recession. And I'll go over why the bond market is pricing a recession. So first of all, these two markets, bonds are what's called smart money. Okay, only institutions, trade bonds. Okay, and so when they tell you something, and we're gonna see why we know that is why they're pricing in a recession, how we know that, but when bond markets are telling you something, people perk their ears and listen, right? Um, you know, and the stock market, anybody can trade it, right? And the stock market is more optimistic, a little bit more bipolar. Like some days it's like last month it was super optimistic, and then all of a sudden it just changed its mood. So there's that to keep in mind. But I think the omen from the bad market is just something I want to keep in mind. And I'm going to use it as an example to put in a small lesson here. And so, how do we know that the bond market is pricing in recession? So, there is something called the yield curve. Okay. And what the yield curve is, let's actually just sort of Google this right now, right? The yield curve is in finance, right? It plots the yield of US Treasuries based off their maturity, right? Now, in a normal market, this line is upward sloping. Why? Because if I ask you, Wei, if I can borrow, $100 for a year, you're going to charge me a lot less than if I ask you to borrow it for 10 years. Because over 10 years, there's so much more risk. I could, default. I could go bankrupt. I could, run away to the Bahamas. I could do many things. So in a normal market, there is an upward sloping yield curve. So just keep that in mind. What signals a recession is when the yield curve inverts, okay? And when the yield curve inverts, what you have is a phenomenon where actually it's predicted basically every single major recession, and I just want to go over that later. I'm not going to put too much emphasis on this, my view. This is just a supporting. I just want to start off with this high level, and then we're going to go into why. There's some other interesting points, but what happens is that the interest rates for short-term maturities or short-term debt is actually higher than the interest rate for long-term. So, borrowing money for a year might actually be more or the same as borrowing it for 10 years for the US government. Now, how's that a thing, right? How's that possible? So, before I go into how that's possible, let's just look at how powerful this is. So, how do we measure yield curve inversion, first of all? Well, we take what is the US 10-year, right, which is at 3.757%, 3.7%, and the US 2-year is at 4.46%. That's inverted because the rate for 2 years is higher than the rate for 10 years. Now, that makes no sense. If I buy a bond from the US government, they're going to pay me more interest over 2 years than they do over 10 years. That makes more sense. That makes no sense, right? It shouldn't make sense, because you would expect if you give money to the government for longer periods, there's more risk, so you should be paid more. So we can actually plot what's called the spread, right? Oh, sorry, I completely forgot to share. I was just sharing the prices of treasuries, but so look what happens here. This is negative now, so this is below zero. So 10-year minus the 2-year. If the 10-year is less than the 2-year, which is weird again, this gets negative. Now look at this. The gray areas are times where we've had a recession. Notice how every single time before there's been a recession, the yield curve has gone negative, right? Now, I don't want to emphasize too much on why that is, because I think that deserves its own lesson. Briefly, if I can just explain quickly, basically, short-term rates like up to 2-year are a reflection of Federal Reserve expectations and what they're going to do to rates. Long-term rates are more of a reflection of growth and inflation data. If you have a scenario where the market thinks there's going to be a recession, okay, first of all, long-term rates should be a bit more depressed, because if you think there's going to be a lot of growth into perpetuity, then the 10 years your barometer of growth. But in a situation, if I think about it this way, let's say I think in 2 years or less there's going to be a recession. If I buy a 2-year treasury, right, and it expires in 2 years, okay, where am I going to put my money? So I'm going to earn 4% for 2 years, and then guess what? There's going to be a situation where I need to reinvest this money after 2 years. I just get the cash. But if there's a recession, this 2-year yield is going to be around zero. Okay. So, this 2-year yield is going to be way too low. And because when there's a recession, the Fed cuts. Okay. And so I don't want that. Okay. And so what ends up happening is that people don't want 2-year short-term debt, because they know that if there's going to be a recession, I'm going to have to roll this over or so and buy another bond once this matures, and I'm going to have to reinvest it at basically zero, because rates go to zero during a recession. So what people do, they allocate out of the 2-year. So when people sell 2-year bonds, rates for the 2-year goes up, and they buy the longer term bond and sort of depress it, and they invert the yield curve a bit. So don't worry if you didn't understand all that. I sort of just put it out there for your interest. But the main takeaway is that every time the yield curve inverts, there's a recession after. And right now, the yield curve's inverted. Does that mean that there's going to be a recession this year? I don't know. There's a lagging period too. And quite frankly, for the analysis we're going to do today, it really doesn't matter. But I wanted to highlight this disconnect between the stock market and the bond market. And particularly, I want to highlight it because the stock market could flip script at any time, right? And I do think that we're headed for a bit more short-term pain. So why that is? So first of all, let's sort of okay. Where to even start here? What we're seeing, could just give a recap of the markets, and then we'll go over this, right? So we have a 50% retracement. So right, stocks rallied, and now they've retraced 50%. Hey,
Although we can't see
thank
the
you.
screen. We can't
Oh,
see the
thank you
screen.
for letting me know. Sorry, yeah, I forget that I have to change every time. Thank you for that. Apologies. There we go. So we've rallied, and then we've retraced 50%. Okay. And now we're in what's called a chop zone. We're just kind of going sideways, okay? That's kind of familiar. We have, throughout this sequence, have seen retracements to the 50%, a chop zone, and then retest the lows. Retracement, chop zone, lows. Retracement, chop zone, lows. As a risk manager, I can't be comfortable putting on the risk right now, right? Again, I'm not looking to predict this like sports betting for binary events. I don't have a time constraint. I don't have sort of stuff that gamblers are beholden to. You have to position yourself. And if this is a battle, I'm really taking. I'm taking the low ground. Why be a hero? And take on risk here. Okay, there is no justifiable case to do that. If you take a view now and we end up breaking out, like if we break above 3,900 on the S&P, we're probably going to retest the highs here. That's very possible, right? If you go long here, and you're right, great. Like, good for you. It's probably not replicable. You kind of just made a prediction that, even if you have all the reasons in the world, it's a bit of a coin flip, right? And so you may be a better predictor than me, quote unquote, but I'm the better risk manager. And it's all about the alphas made in the risk management. So I want to just quickly show this. Now, a week ago, we thought the markets were forming a descending triangle. That is no longer the case. So we've switched from a bearish pattern to kind of a neutral pattern. But as I said, unless we break above 3,900, there is no real bull argument. And this backdrop, and we're going to say a few more reasons why, it is bearish. So you have this sort of pattern where it's been very difficult for the market to rally after a 50% retracement. I don't have them plotted here, but the 20, the 50-day, and the 100-day moving averages are all converging and about to cross. And that is bearish because they're crossing, the smaller MAs are crossing are going under the longer term moving averages, right? They call it death cross if you want to look it up. And what we're having a bunch of what's called inside days. So we're not really we're closing inside yesterday's trading range. That's just not like when people are building up positions, especially large positions, you don't really see inside days, okay? And that's just not really, you know, if I had to flip a coin and bet whether this time it's different, I just don't have the conviction to say, okay, we've seen this pattern every single time. This time is different, okay? And so if we break the December lows of 3750, okay, uh, we're gonna see a lot more downside, and that's really how you should um, look at the market. You identify levels. You don't just wake up one morning and say, "Yep, right here, time to go up." Like you can if you're a long-term investor, but the way it's done is you identify some levels and pivot point. You have a bias. My bias is obviously bearish, which is why I'm sort of watching. And then you identify some levels and you say, okay, if we meaningfully break out of 3,900, the next target is around here. So you can make this spread, where you have a better chance of making this spread if you just wait for price to break above 3,900. That's valuable information. Whereas if we break below 3,700, we have a long way to go. We have even lower to go. So don't be a hero. This is what distinguishes the bad traders from the good, and perhaps even the good traders from the great eventually. Like it's this patience and being able to see, you know, when being able to identify levels where stuff changes. And in this case, it's very easy. We have a well-defined range from 3750 to 3900 on the S&P. I'm biased to say we retest 3700. If, what prices are not just random. When you pull up the stock app on your phone, if you see price hovering around 3750, maybe even peeking its head below there, that's your sign that we're probably going to see even lower prices. Now, what do the bulls have going for them? And this is going to be part of today's lesson. Today's lesson, we're going to talk about volume profiles. Okay. So let's just introduce volume. By the way, first, before I go into that, is there any wait? Is there any questions? Wait, if did you have anything you sort of wanted to add about the markets or your view?
Yeah, maybe just 2 points. First, I just want to
Yes.
answer Kid Leo's question here,
Yes.
which is more of a question of, okay, is it possible for us to determine where it would go? So,
Oh yeah.
Kid Leo, I
Hmm.
think if you joined us on this series, and we'll keep coming back to this point, and this is the fundamental mistake that every single beginner makes when they come into the market. They think the market is about predicting where prices are going to go. That's not it.
Hmm.
Stop doing that. If there's one thing you take away from anything that we say, is stop trying to predict where prices are going to go. If you
Hmm.
spend your entire career doing that, you will lose a shit ton of money. I guarantee you, if you try to predict where prices are going to go, you may get lucky for a while, you may feel great about yourself, and then there's a day of reckoning and you're going to lose a lot.
Hmm.
Because the market is not about predicting where prices go. It's about risk management. So everything that Otto shows you guys, the things that he's trying to assess and break down for you, he's never making a prediction necessarily of where prices are going to go, other than having some type of view to say the probabilities are in my favor to have a bullish view. The
Hmm.
probabilities are in my favor to have a bearish view. That's it. And
Hmm.
if you take a step back and if you think about the best traders in the world, they actually don't care where the price is going. They do not care. So if you listen to like a lot of the financial media pundits and people who have large followings, you know, a lot of times they'll say like S&P 4,000 or ETH 10K. That's clickbait. The truth is,
Yeah.
no one fucking knows, right? And
Mm-hmm.
if someone pretends like they do know, they are bullshitting, right?
Mm-hmm. Mm-hmm.
So the starting point to all of this is reframe how you think about markets. Markets are not
Mm-hmm.
about predicting where price is going. Markets are about understanding what is happening right now.
Mm-hmm.
It's
Mm-hmm.
discovery, right? It's discovery of what is happening in the market right now. How are the bulls and bears positioned? We always use this
Mm-hmm.
analogy of battlegrounds,
Mm-hmm.
right? Markets are a battle between buyer and sellers. Why are sellers making a certain decision? Why are buyers making a certain decision? Who's winning at this moment in time? That's what the market is about. So
Mm-hmm.
as Otto is going through all of this stuff, if you're listening carefully, you'll see that he's saying, well, here's the case for the bears. Here's the case for the bulls. Right? And his current view is probably a little bit more biased toward the bears,
Mm-hmm.
towards the bears side. But really, when
Short
you
term.
zoom out, yeah, short term, when you zoom out, it's kind of what we're saying right now is highly uncertain.
Mm-hmm.
Like we kind of don't know. Like it's a really messy market out there right now. No one is really getting a outright advantage,
Mm-hmm.
and because there's a lot of uncertainty. Now, when you take that into your and filter it into your decision making process, what your decision making ought to be at this moment is, do I take risk when I'm uncertain?
Mm-hmm.
The answer is generally no. I want to take risk when I have really high conviction. Things are pretty straightforward. There's clear like patterns establishing themselves. Things are trending. That's when you become more aggressive, right? When all of these things start to converge and they're all like lighting up green.
Mm-hmm.
In a situation that we're in right now, we always say, why try to be a hero right now?
Mm-hmm.
Your actions are probably not going to be paying off. And you may get a few
Mm-hmm.
of your calls right in the short term, but the one thing that you get wrong is going to do a lot of damage.
Mm-hmm.
And that's not how you make money over the long term. So
Mm-hmm.
that was the first point I want to make. The second point, when Otto started with the bond market, I just want to make a point like we don't do analysis in isolation. So Otto's never going to
Mm-hmm.
just look at the S&P chart and just read the S&P chart as if that's the Bible. You're looking at all of these different types of assets for clues to give you some insight in terms of like, well, how are different types of people in the market interpreting information?
Mm-hmm.
And sometimes you'll see divergences in terms of, well, stock market saying one thing, bond market saying another. Commodity markets, are they telling the same story as equity markets, or are they telling the same story of bond markets? Right? All of these things factor into it. So I think we spend a lot of time on S&P because it's easier to illustrate ideas, but it's never about looking at just one asset.
Mm-hmm.
You can't make decisions that way. Okay,
Mm-hmm.
so those are kind of the couple of things I want to highlight. But yeah, definitely keep
Thank
going.
you. Couldn't have said it better myself. The I want to zoom into that point about battlegrounds, way, right? Because again, even last week when we said descending triangle, just because you see a descender, you don't short, right? Like I said, we short if you're a short-term trade once we break the lows, 37.50. The descending triangle is telling you we might get there. It becomes a bit more neutral, but it's not telling you the opposite. We need to stay above 3,900. So zoom into the battleground, okay? Think about it as you're in a war and you need to get position, high ground, low ground. Look at all this volume that's sold. Look at this spike in volume that managed to drive the price down. And now we're going sideways, but look how little volume and price action there's. Okay, this is over the holiday period, but basically, if I'm establishing a position, like if I'm in a war and I'm like, I'm going to take this hill, I got no backup. I got very little backup. And it's about trying to identify You know, it's not about predicting like a coin flip. It's about saying, yeah, exactly as Wei said. What are the probabilities? What's the bull case and what are the probabilities of that? And what's the bear case? And then feel free to have a view of what you think is more likely to happen, but you don't take action on it. You definitely don't take action on it if you're a long-term investor, because if you're a long-term investor seeing this, your cue is to just wait and not buy the dip. But if you're a short-term investor, you need to wait until one of these pivots break, and then you piggyback on the trade. There's another thing to help the bear case. What are these chop zones, right? They're bear flags, okay? This is another concept or lesson of what a bear flag is. A bear flag is when you get a sharp drop, some sideways action, usually low conviction, low volume sideways action, and then you get you know it's usually followed up by another drop, right? And again, just another reason why if you put a gun to my head now, I say 3750 breaks, and then once that breaks, you can get in somewhere around here, make this spread. This is very easy. It's an easy spread sort of to make because, again, to the other point, there's a volume gap, and this is where we get into the next lesson. Okay, so what a volume gap is. Okay, and let me just change my view. Okay, actually, I don't need to change my view. What a volume gap is that what a volume profile is that. So if you go into Trading View, all softwares will have this. You go to fixed range volume profile. You pick a range. Now, usually, if it's a short term, you pick it from what's called the swing low, the local low, to wherever the trend is now. And instantly, we get what we see as a distribution of where volume has been concentrating. Okay, and so I just want to make this point here. So, for example, when people see a huge spike, like for example, this spike right here, not a lot of volume was clearing around there, right? So this could be one trade, okay? But it moves the price, right? Like I could make my own coin and trade it up to $1,000 and have one trade, and then you look at the chart and says, "Oh my God, this coin hit $1,000." Yeah, but there was no liquidity up there, right? So volume profiles tell you where the liquidity is. So this is called a shelf. This is a demand shelf. This is actually one of the strongest bull cases, right, for bulls right now that we're sitting on what's called this volume shelf. So a lot of volume has been clearing around here, okay? A volume gap is the opposite, right? And so firstly, I just want to say that past times where we've had a bear flag, these situations, we've been sitting on a volume shelf as well, a demand shelf. So, kind of loses a bit of significance in this case. But it's still a powerful predictive tool because it tells you when there's a volume gap, there's violent moves. Look at this. We were at a demand shelf, okay? And then we broke into this gap. Look how violent that move is. I'm gonna let you guys do this research if you want, but plot some volume profiles and see how much more violent the moves are in between in volume gaps. And that's just basically because, institutions, when they navigate their book, it's almost like turning a cruise ship or an oil tanker, right? If you're trading a portfolio, a small portfolio, even up to a couple million, you're like a jet boat. You can wake up bullish today and then dump everything tomorrow and have basically no market impact. But these institutions have market impact. So when they navigate in and out of the markets, okay, they can't be building positions like here in between this volume gap because there's no liquidity there, right? And that's really key to keep in mind. So The institutions will be sort of the patient ones and wait for demand shelves, right? Now, where that is, okay, you can move this back and figure it out. This is just a random point there, but eventually they want to accumulate in these zones, okay, in demand zones or supply zones. So that's just something to keep in mind. And I just want to emphasize that if we break this level, there's a huge volume gap. And if we break to the highs, which it's less likely, we might need a catalyst or a positive news event for that to happen that isn't priced in. But there's going to be a violent ascent back up to 39.60. That's why I say don't feel the need to pile in here. If we break and start peaking above into this volume gap, great. You have so much more to take. You have a lot of room to take. It's not like the move is over. The volume gap is telling you that the move is going to continue in that direction and stop probably where we have a shelf. Okay, so uh, you know you're getting a sense of sort of how we're looking at the market, right? And there's wondering if it's worth it to discuss now, but yeah, I think before I go into it, I just want to reiterate all the sort of reasons why bulls and bears might be what cases they have. So the bulls case is that you're sitting on a volume shelf, okay? You're technically at support, okay? 50 retracement is a good sort of point in time to rally. And the put call ratio, next lesson, is skewed in your favor, but that's a bit misleading. What is the put call ratio? So the put call ratio is basically the ratio of puts bought to calls. A put is a bearish option bet, and the call is a bullish option bet. Okay, playing it very simply. When you have a put call ratio that is going up or spiking, it's telling you investors are buying way more puts than they are calls. Now, interesting, historically, this has actually been a contrarian indicator that when put call ratio spikes, that's sort of the time where, the opposite is going to happen. It's like, okay, we've fully exhausted the move, right? It's time to turn. But it's been losing a bit of its predictive power. So look at this article. Put call ratio is not a buy signal for stocks anymore. And I think there's a few reasons for that, which I don't want to spend too much time on. I just sort of want to give you guys a taste and then pique your interest a bit. But first of all, buying the dip hasn't really been a dominant strategy. And so people aren't really long buys. People usually buy puts for hedges. And usually when the put call ratio spikes, people have maxed out their hedges. In this case, I think the dominant trade has been to the downside. So the article actually goes into a lot of reasons, explains a bit better than I can. But the point here is that bulls are using the put call ratio as one of their reasons to be bullish. And, that's kind of weak. Okay, that's kind of weak. So I'm like, okay, what's next? What's next? Bonds are pricing in recession. Okay, that's not good for stocks. What are commodities doing? Commodities, okay, they've kind of followed stocks. It's still off. They're still off the highs. So commodities are not making highs, which you would see, which, you don't see in a recession. Commodities are telling you the same thing as the bond market. They're pretty depressed, and so I think stocks are the only outlier here. So from a macro perspective, stocks are basically telling you, hey, the smart money is wrong. Who trades oil and bonds? Like, it's smart money. So the stock market's telling you they're wrong. Okay, like I need to see a lot for that to happen. I think what stocks have going for them really is that inflation annualized could start getting really low. On a monthly basis, inflation is like 0.2%. If you annualize that, next December, we're probably around 2-3% CPI. Now, next December is a long time away. And I think personally, by the time inflation gets to even 5-6%, if it, the market's already going to be jumping the gun and being like, okay, 3% is next. Fed target's going to be hit. So, but here's the problem with that thesis. It's true now. It was true before. It'll probably be true. It was true 2 months ago. It'll probably be true in a month. The point is, it has no timing value. It's just a state. It's just a condition. And you can't trade around that. Now, if you're an ultra long-term investor, Charlie Munger, Warren Buffett, I would still wait, but you can make the case and say, we've passed the halfway line for inflation. Valuations are really good. Start piling in. That's sort of fine, right? But from a short-term perspective, you can't rely on that type of information. Okay, and so I'm just looking through my notes here. Wait, if you have, do you have anything? Do you want to add?
Yeah, maybe just to overlay the concept of smart money, retail money. And going back to the analogy that markets are basically a game where different people play this game, right? We talk about battle zones. You should think about markets as a game. The question is who's playing which game? Okay, so you guys need to think about this, because if I ask most retail investors, and like I would consider all of us in this room to be retail, right? Because we don't have access to millions of dollars of capital. So like we're trading our own personal accounts. Retail has access primarily to risk assets like stocks, crypto. That's about it. Right? Like if I were to ask people here, does anyone trade oil futures? Right? Do you guys trade gold futures? Do you guys trade euro dollar futures? Like if I throw out these assets, probably some of these stuff like you've never even heard of. So what that means is in these other assets, there is a different set of players playing those games. Right? Because the average retail person is not in that market, and for good reason, because they don't get it, it's too complex, and because also these other markets, you need large pools of capital to play. You can't play with $100, right? You can't trade futures with a very low sums of capital, right? So what that tells you is when you look at an S&P chart, when you look at a single stock, versus when you look at oil futures or copper futures or things like that, you have to understand the people who are playing that game is different. So when Otto says, hey, if you look at all of these other asset classes like bonds, commodities, and what have you, they're telling a slightly different story than equities. Right? And what that should be telling you is, well, why is it that the professional traders are expressing a different view to the people who are more likely playing in the retail sandbox, which is the equities? Right? This is why people generally say equities is dumb money. It's kind of derogatory, but it's a reflection of the fact that everyone has access to equities. So by virtue of that, you have a lot of amateur day traders, retail people in those markets. So if you have a lot of those people, they express ideas differently, right? They do in totality, in aggregate, have an impact on price. So usually, like this is where you have to start looking at some of the other asset classes, and what you're taking away is, hey, if there's an asset where there's more professionals trading it and it's telling me a slightly different story than equities, that's information that's important. Right? So then that that adds to your view of, okay, is it better to take risk now? Am I certain in my position? Am I certain in the fact that the price may go in this direction? Every single decision that you make in markets is about managing the probabilities of being right.
Mm-hmm.
And if you're more right than wrong over the long term and you position size properly, that's how you win. It's not about like predicting, making big bets, none of that stuff. So I just wanted to overlay that. And then where auto started on the bond market, that's a really big signal. The other, like, can you go back to the yield
Yeah.
curve chart? Yeah, I
Yep.
think that's a really important concept that people need to understand what a
Yep.
yield curve is and why it has different shapes, right?
Do you
So
want to see the yield curve itself or
yeah,
the
the
spread?
curve itself, the curve itself.
Yeah.
So if you click on the, yeah, okay. So starting here, this is the normal shape of a yield curve. And what a yield curve is telling you is what is the prevailing interest rate the markets are assigning to a bond which has this kind of maturity profile. What a maturity is basically when does the bond expire, right? So on the x-axis, what you see here is, well, for a bond that expires basically a few months from now, the prevailing interest rate on that bond is close to 1.5%. But if you go further out into the maturity profile, so a longer dated bond, like a 30-year bond, a bond that matures in 30 years, has an interest rate of above 3%. Why is this a normal profile? This is normal because there's more risk of locking up your money for a longer period of time, right? This is the concept of illiquidity, right? If I were to give you, like, if I were to lend you money and it's going to take me 30 years to get that money back, I should charge you a higher interest because a lot could happen in 30 years. A lot of things can go wrong, right? If I were to lend you money on a 3-month basis, I can accept a lower interest rate because I'm not giving up so much time value, right? So a
Mm-hmm.
normal yield curve should look like this. It's upward sloping, right? That just
Mm-hmm.
makes sense. So now what Otto was highlighting is today, right now, the yield curve is inverted. And what the yield curve inversion is that actually short-term yields are higher than long-term yields. You know, in some ways, that doesn't even make any sense. Like, why would anyone want to lend money at a lower interest rate for a longer period of time than lending money on a shorter term time basis?
Mm-hmm.
Like why what how like first of all the question is how does that even happen, right?
Mm-hmm.
Because is like from a financial theory perspective it doesn't make any sense, and yet this is what's happening right now. So maybe that's an open question. Like, does anyone
Yeah.
want to venture a guess why this happens in the market? Like, I like to see if
You
people.
asking me?
No, I'm just asking in general. People can
Oh.
leave it in the comment section. I know
Mm-hmm.
you know. I don't know, but
Yeah.
I want to see if people can figure out why this potentially happens. And the clue here is, remember, different people play different games in markets,
Mm-hmm.
right? This
Mm-hmm.
this basically, yeah, maybe like it seems like reply guy or may have a guess here. And this is like it's just a side point. This is very interesting as like as you observe markets and learn about things over time, you'll start to find these anomalies, and these anomalies are actually signals that you should study more
Mm-hmm.
because they intuitively do not make sense. But when they happen, it actually gives you a lot of information as to what's going on right now.
Mm-hmm.
Okay, so reply guy says maybe long-term investors are more or something. Economies plan to recover in the long run, but not in the short run. Okay, so you guys are close, but The starting point to understanding why yield curves can invert is to understand that different people play different games. Okay, so what it suggests is that the type of people who are playing in the shorter term is different than the types of people who are playing in the longer term,
Mhm.
right? Because if they were the same exact group of people, they should be making decisions in a similar way,
Mhm.
right? So let's distill it to the lowest common denominator. If I was the only person in the market and I have this theory that yield curves should always be upward sloping, and the yield curves should never be inverted, right? Because I'm the only person who's making that decision in the market. And that the shape of the curves should always reflect what my belief systems are. Now, if I introduce another person to the market, Otto has a different view than I am, and he tends to trade in the outer parts of the curve, longer term maturity. And he only trades there. But his views on how this thing works is different than mine. Now we can have various different shapes to the yield curve because sometimes I could be expressing a certain view and Otto could be expressing another view. And you can start to see how the yield curve is going to shift based on whether or not my kind of purchasing power is more dominant relative to Otto's in the market, right? So
Mhm.
when you look at a yield curve, there's different groups of players playing on that curve. Who's playing on the outer part of the curve? The long dated bond market is usually really, really large pools of capital. Okay, so these are like pension funds, large asset management funds, sovereign wealth funds, right? Countries and their savings, they put it into longer dated maturity assets. There's a crucial other thing in terms of a player in the shorter end of the market. That player is the Fed and central banks, right?
Mhm.
So, and the other thing
Yep.
to realize is that the Fed and the central banks do not have as much control of longer dated securities as they do on shorter dated securities,
Mhm.
right? When the Fed increases interest rates or decreases interest rates, it has almost a direct impact on the short end because the Fed is setting a very short dated interest rate. So every other financial market participant responds to the Fed's actions on the short end. As you go out in the maturity curve, the Fed has lower and lower impact of influencing those players to make similar decisions. So when you
Mhm.
get out into the 10, 20, 30 years, those groups of players, they are aware of what's happening on the short end, but they're making their decisions independently, right,
Mhm.
of what's happening on the short end. Sometimes it could be aligned, other times it could be completely different, right? So right now what's happening is the Fed is saying inflation is high, we have to increase the cost of borrowing, we have to increase the cost of money. So they raise short-term interest rates. Meanwhile, what the long-term people are saying is, well, we understand you're increasing interest rates, but ultimately what this means is you're going to probably over tighten money supply, right? You're going to over tighten liquidity, and that's going to lead to recessionary pressures. So my outlook on the economy is actually quite poor. And if my
And that's
outlook
what
on the
long-term
economy,
rates represent.
exactly. So if I have a negative outlook on the economy going to in the long term, what I'm going to do is I actually think the interest rates of the long term are going to be lower because the Fed is going to be forced to lower rates yet again.
Mhm.
Right? So that's where the
Yeah.
long-term maturity is telling you. Those players are saying, okay, you keep raising interest rates, it's gonna have to come back down because
Yep.
you're going to basically weaken the economy,
Mhm.
right? And
Yep.
now it starts to kind of make sense why yield curve inversion usually predict recessions,
Mhm.
right? Is
Mhm.
because the longer data maturity bond market traders who are smart money, this is, millions of dollars moving around. They're usually right. They're not
Hmm.
guaranteed to be right. They're usually right.
Yeah.
So the smart money is betting to say we're probably going into a recession. The Fed is going to be forced to lower rates at some point. It's not going to be in the near term, but when you get out into the maturity curve, the bet is that rates have to come down. And it's all
Hmm.
kind of converging in the same direction, right? Because if you think we're going to a recession, you're going to be more risk averse. And if you're risk averse, what are you going to do? If you're a professional money manager, you're going to be selling stocks and buying bonds.
Hmm.
And
And
as
that
you buy
pushes rates.
bonds, it pushes the rates
Yeah.
down, right?
Yeah.
So this is I just wanted to kind of try to piece
Hmm.
it all together why an inverted yield curve is actually signal. It's telling
Hmm.
you something very important. And why does it usually predict recessions?
Hmm. No, fantastic. Yeah. And wait, the opposite is true too. When times are looking good, long end rates go up. And that makes sense because an investor thinks, why should I lock up my money for 10 years to the government for 3, 4%? Everything's booming, oil's booming, tech's booming. I could make so much money in 10 years. Screw your 3%. I need more. And I sell bonds, and that pushes long-term rates up, right?
Yeah.
And that's how you feel in so yeah, absolutely. Um, Super important point. Thanks, Wei. The and then from a trader's psychology, if you think, let's say we're right, let's say we have a crystal ball and there's going to be a recession soon, which is going to last 1 to 2 years, like the bond market's telling us. If I buy a 2 year note now, it expires in 2 years. It's technically going to expire in the middle of a recession. What happens in the middle of a recession? Short term rates are very low because the Fed cuts. So I'm gonna have to rebuy a bond, a 2 year bond, for that gives me 0%. And by that point, long term rates are gonna be no, that makes no sense. And that causes even more upward pressure on yields. The economy is crap, so you can't get a good rate on the long end. So you're kind of just stuck, and that's kind of leads to uh, this sort of phenomena here. So I'm really glad brought this up. This is super important stuff to think about in the markets. But to wrap it up and sort of bring it home here, okay? You know, no one is saying at the minimum this tells me wait, it's not time to buy the dip. Okay, great. If there's a breakout here, okay, we have a lot. The next target is 410. You don't have to make that call here. You can make it somewhere around here. That's probably good conviction. Same with going short. Okay, so that makes you really puts you in a great mindset because now you're not beholden to one view. You have a bias, but you're not like losing sleep. Imagine we shorted around here or whatnot, right? And it just keeps going sideways, and you're just bleeding. Either theta or interest or just opportunity cost. You know that's sort of I think there's enough reasons to tell us why you should at least be cautious from a macro perspective, from a technical perspective too. And one other thing I wanted to bring up, we made a post on this Tesla. So Tesla is a good barometer of risk taking. Okay. Same with Arc Genomics, but let's look at Tesla. Um, this is like if I'm a doctor, I'm testing the part of the body that gives me a sign for risk appetite. Okay, and this is looking very unhealthy. And so one thing I made a post about this, but I'll rehash it. When you have assets that are so volatile and increase exponentially, like Tesla and Bitcoin, it's good to put them in a log chart. Now, for the purpose of time, I would encourage you to look at the Twitter posts of why we put it into log. But basically, you know, I if once we put this into log, okay, I and by the way, we called for short around 125, 130, okay? And now we're now at 109, 108. I'm sorry, this is your target. 70. I'm not saying it'll go straight down, but you might get some sideways action and then you fall out around 85. Wait, I can't come into your office, and pitch you something in no man's land right here. Okay. And so it's about picking your battle. you know,
Yeah.
this is another thing that kind of bolsters the whole bearish case in general. Risk taking looks terrible. Macros still not turning. Macros, it's slower, but it's telling you you gotta wait. The patterns in the markets are not really um, that great. The MAs are all going into a bearish cross. We've seen this pattern before. At the minimum, wait. And if you want to get cute and short, there's a volume gap, which, once we break this shelf, if this shelf breaks, you have a volume gap, which is going to lead to more downside. You have so much opportunity to take the spread. Same on the upside. So if there's a bullish catalyst, which there needs to be for the market to rally, in my opinion, just because technically and fundamentally right now, if things are as is, that's not enough of a case. If it rallies, don't think like, oh, it's wrong to think, oh, I was wrong. You're not beholden to a certain position. I actually want to be long if we start making some consecutive closes above 3,900. Maybe commodities start changing a bit. Maybe rates start coming down. Maybe rates take out these lows, 3.67. So right now, I'm just not seeing that. And yeah, I think Tesla's a good omen as well. And it's just a question of pivot points. If the bulls take out this level, next target is the next demand shelf. Okay, we just zoom through that volume gap, and that's our next target. So you play it level to level, okay? And I think this is a very, very stark contrast to most analysis that you see elsewhere, which is just basically can be distilled to buy the dip or, just trust me, bro, type analysis where it's like,
Just me.
it's true. It's at support. Trust me, it'll hold. It's like, okay, like what are your level? It doesn't work. Why today? It's like, why today of all days? It's like, what do you say? And so if you've noticed a common theme, we always say, okay, if this level breaks, much more of this is going to happen. If it level breaks up, much more of that's very valuable information. And at least you're waiting for a confirmation instead of just in no man's land flipping a coin and saying, let's hope there's a bullish catalyst that takes us up. So um, we covered a lot. We covered a lot. So wait, any closing thoughts?
No, I think, I mean, we're gonna keep doing this, so a lot of it is gonna be reinforcing ideas over time.
Yeah.
And I think maybe the parting thought here is just markets are so complex and deep, right? So
Mm-hmm.
as you unpack what's happening here, there is years and years and years of learning, and you're gonna
Mm-hmm.
constantly be learning about new things. And a lot of it is just, it's pretty frustrating. It's not simple. And we're when Otto's preparing this content is not intended to be entertainment necessarily, because I think what most of financial media that you see publicly is entertainment. They're selling you something entertaining. They're trying to like sell you something that gives you a dopamine high. Uh,
Mm-hmm.
markets can give you that in different moments of time, but it's like it's a journey to learn a lot about the theory behind why things behave the way they do. And it's also like really at the end of the day, you're going to learn a lot about yourself because you're interacting with this thing and it's teaching you about your own tendencies, etc. So if you like if there's a lot going on right now, don't worry, stick to it. Things will start to make sense and formulate intuition over time. But this is all part of a journey to become better. At the very least, we hope through these sessions, what I hope you guys get out of it is for you to start seeing markets a different way, like understanding it from a different perspective.
Mm.
That is the most important thing. I would hate for people to leave with an impression that the market's all about making bets and
Mm.
predicting things and making calls. And it's like as soon as you're able to steer yourself away from that mentality and see it from a different perspective, which is what we're trying to show you, that is going to, hopefully mitigate a lot of the mistakes that you're going to make.
Mhm.
And mitigating those mistakes are worth a lot. Like I always say, like these mistakes that you make in markets, and we've all made them. None of this is to say like Otto, myself, or other like guppy. Like we're not saying we're always right. We're not saying we always make money. We're not saying that we've never lost money. In fact, we've lost money. Sometimes
Mhm.
a lot of money, but every single
Part of
time it's a hard lesson that you have to take away. And what you're trying to do is not make that mistake again. Because
it.
like this is for keeps. When you start playing this game, this is high stakes. And sometimes when you make a mistake, it really hurts, right? And it wipes out a lot of the good things that you've done. That's the
Mhm.
thing that we try to, if we can save people from making those type of mistakes, I think is worthwhile,
Mm.
right? Because
Mhm.
when you make a really bad decision, you could have made 100 correct decisions and made money on all of those calls. You made one bad call, you're wiped out.
Mhm.
It happens all the time. It happens all the time. It happens to beginners. It happens to people who've been in the markets for a long time. It happens to people who manage small amounts of money. It happens to people managing billions of dollars of money. You don't want to make those fatal errors.
Mm.
I think if there's any value to what we're trying to do here, I hope we can help people avoid some of those critical errors where they're betting the farm and they make a huge loss. And those are difficult to recover from.
That's it. No,
Yeah.
phenomenal point. Like, if before I just say something here, it's like reward to risk is everything. Like, if I short here, okay, and then I get, it starts rallying up until here. Like, that's really painful. I'm taking a lot of losses, and I still might be right. That's the crazy part. I still might be right. And then if it breaks out, forget about it. You're wrong. But you don't short in no man's land. Once we get a break here, if you want to feel conviction, but you get a retest, you short, your potential reward is all this space here. But where do you place your stop? Back inside the range. So you're risking a little bit and then you reevaluate. And that's if you're willing to take that risk, that's how you do it. Not everybody, and I'm not saying that's the best strategy to do. I think that's pretty if there's some people that do it well, and but that's how you would do it, right? And then you're back into this range and then you reevaluate. Then you have no position. You still might be right because a lot of times you get whipsawed, right? So wait until don't trade and trade the travels, basically, as we say. And to Way's point, like that's everything you want to hear. Way is I'm just an analyst. Way is too humble. He was manager managing billions. I've learned so much from him, from this guy. Like there's so much noise and BS in the market, and I've always seen Way as like a filter to just like clarity and whatnot, and it's really helped. Is sort of my view. It's not about it's the technical skills you pick up, but then it's sort of just having a view, and just having that clarity to not to filter out the noise and see what's important. And I think that's an incredible skill. that he has and that I try and pick up. And so, yeah, that no, you guys are super lucky, and we're super happy to share this information with you guys. Because as we said, if we can avoid mistakes, you guys making mistakes like that, like asymmetrically trading Solana, or taking a stab and shorting right in the middle of this, right, just because you think it'll break, like it's worth it for us, right? And you know,
Yeah.
and we're super happy to. Yeah. Well, one thing that you said that I didn't like is that you said I'm not entertaining. What do you want me to
I wasn't saying
do?
you're not entertaining. I'm saying
I'm
like
just
this
kidding.
this is yeah, this is probably not what people feel like
Yeah,
this an
I know
analysis
what you
should
mean.
be, right? Because like what's out there in the public sphere is basically it's like I don't know. I don't even know what the analogy is. It's like trash television. You know what I mean?
Yeah, yeah,
It
yeah.
has no
Well,
substance. It's just there to try to get an action out of you or a
yeah,
reaction out of you. So
yeah.
it's
I'm just
that's
teasing.
not useful. Yeah.
Yeah,
Yeah.
Jim Cramer pressing buttons, buy, 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 sell, 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 and then the next day he'll give a view on like this one company, and then the next week he'll trash the entire industry, and it's like, what is happening here? It's like,
Yeah.
I'll wear some colored shirts, get some buttons way, and then maybe
Exactly.
we can make this more interesting.
We'll up the production of it over time.
I'm
Yeah.
down.
Awesome.
Okay,
Thanks
cool.
everyone.
Thanks
We'll
everyone for joining us.
yeah, always do what the
Ma-
opposite of what Kramer says, for sure.
yeah,
100%
Mandor
of the
brought.
time.
That's a good strategy.
That's always a good strategy. All right. Well, so we'll be back next Thursday every week. Tomorrow we're gonna do another hangout. So it's scheduled for noon Eastern, a little bit later in the day for people in North America, but hopefully people can join us. And yeah, a lot of exciting things to come in the arena. I'll highlight some of the stuff tomorrow at the hangout, and there'll be a very important AMA next Wednesday. We'll be posting a event invite link shortly, probably today. That's one that you don't want to miss because we're going to be announcing a lot of changes coming in 2023, exciting information, and there's just going to be a lot more to do within the community. Yeah, looking forward to that. So join tomorrow during the hangout. You may get a little bit of alpha before the actual AMA on Wednesday next week. Thanks, guys.
Go.
We'll talk to you soon.
See you guys.
Take care, everyone.
Bye bye.